What's leverage? You've probably heard about leverage in trading, but what is it exactly? In a nutshell, leverage is about borrowing money to make trades. This is helpful if you only have a small amount of money in your account, because you can use leverage to borrow more and make bigger investments. It might help to think of leverage as being similar to a loan. For example, let's say you want to buy a car for $50,000, but you only have $5,000. To get the $50,000 required, you'd put in $5,000 of your own money and borrow the rest from the bank. To put it another way, for every $1 you're contributing, the bank is giving you $10. That's leverage of 1 to 10. So how does leverage work in trading? Leveraged trading lets you control trade positions worth more than the balance of your account. Let's say you have a trading account with $1,000 in it, and you're using a 1 to 100 leverage. Your $1,000 capital multiplied by 1 to 100 leverage means you could open positions worth $100,000. Does leverage help with profit or loss? By itself, leverage doesn't cause a trade to make or lose more money. Whether you're using a 1 to 10 or 1 to 100 leverage, your profits or losses ultimately depend on the price movements of the asset. What leverage does is give you access to more trading opportunities. An account with 1 to 10 leverage might only provide enough margin to get into a one-lot trade position. However, an account with a 1 to 100 leverage would allow you to get into 10 lots. How does it happen? Leverage affects the amount of margin you need to keep a trade open. The higher your leverage, the less margin, your own money, you need to have to open a new trade. And that's the tricky part. Higher leverage lets you open larger positions, so you can generate larger profits, which is very exciting. But higher leverage also amplifies losses, so you can lose more than you expected. So just remember that although leverage is useful and can open more trading possibilities, it has to be managed carefully.